We are staring at something that has not happened in modern commodity markets. Silver is about to cross $100 per ounce. Not in months, not in quarters, within weeks, maybe days. And the forces driving this move are so fundamentally different from anything we have seen in precious metals history that most investors, most analysts, most institutions are completely unprepared for what is coming. This is not a prediction based on chart patterns or technical indicators or sentiment surveys. This is a forecast based on observable supply destruction, documented industrial panic, and a scramble for strategic metal that is intensifying by the hour. The word strategic matters here. Silver is no longer being treated as a commodity you can buy when you need it. Silver is being reclassified in corporate boardrooms and government ministries as a strategic resource. The same category as lithium, as rare earth elements, as semiconductor grade silicon, as any input that is critical to national security, economic competitiveness, and technological infrastructure. And when a commodity becomes strategic, the rules change completely. Price becomes secondary. Availability becomes everything. And right now, availability is collapsing. Look at what happened in the last 72 hours. 3 separate solar manufacturers issued statements about production delays due to silver paste shortages, not price concerns, shortages. The metal is not available at any price with acceptable delivery timelines. A major electronics supplier in South Korea placed an order for 6 months of forward inventory, paying a 12% premium over spot price just to lock in supply. 12%. That is not a normal premium. That is panic premium. That is the premium you pay when you know that if you do not secure the metal now, you will not be able to secure it at all. The Perth Mint in Australia suspended silver coin sales for the 3rd time this month. Not because they ran out of blanks, because they cannot source enough silver to produce the blanks. The United States Mint is rationing silver eagles to authorized dealers on an allocation basis. Dealers are receiving 30% of their requested quantity. The other 70% is simply not available. And these are government mints. These are institutions with priority access to refinery output. If they cannot get metal, what does that tell you about the broader market? It tells you that we are in the early stages of a physical scramble, a race to secure tangible metal before the music stops. And when the music stops in a commodity market, when physical availability vanishes, the price does not rise gradually. It gaps, it jumps, it goes vertical. Because the market is no longer discovering price through the normal interaction of supply and demand. The market is discovering the price at which holders are willing to part with a scarce strategic resource. And that price is always higher than anyone expects. Let me explain why silver is being reclassified as strategic and why that reclassification is the single most important development in this market right now. For decades, silver was treated as a precious metal with some industrial uses. It was jewelry, it was coinage, it was photography before digital cameras killed that market. It was a speculative vehicle for traders who wanted volatility. But it was never mission critical. It was never the kind of material that could halt production across entire industries if supply was interrupted. That has changed. Silver is now embedded in technologies that define economic and military power in the 21st century. Solar energy, electric vehicles, 5G telecommunications infrastructure, advanced weapon systems, medical diagnostics, water purification. These are not luxury applications. These are not discretionary uses. These are foundational technologies that nations are betting their futures on, and every single one of them requires silver in quantities that cannot be reduced without compromising performance. A single solar panel uses approximately 20 grams of silver. That does not sound like much until you understand the scale of solar deployment. China is installing over 200 gigawatts of solar capacity per year. Each gigawatt requires roughly 30 metric tons of silver. That is 6,000 metric tons of silver annually just for Chinese solar. 6,000 tons, that is nearly 200 million ounces. And China is not slowing down. China is accelerating because energy independence is a strategic priority, because decarbonization is a geopolitical imperative, because the nation that controls renewable energy manufacturing controls the energy economy of the future. The same logic applies to electric vehicles. Each EV contains between 25 and 50 grams of silver, depending on the model and the electronics package. Global EV production is projected to reach 20 million units this year at an average of 35 grams per vehicle. That is 700 metric tons of silver. 22 million ounces. And EV adoption is not slowing. It is accelerating because transportation electrification is not a trend. It is a transition, a permanent structural shift in how humans move goods and people. And that transition runs on silver. Military applications add another layer of strategic importance: advanced radar systems, missile guidance systems, electronic warfare platforms, communication networks. Silver is the best electrical conductor of any metal. It is the most reflective. It is the most thermally conductive. For military applications where performance is measured in microseconds and reliability is measured in mission success rates, silver is irreplaceable. You cannot substitute copper in a radar array that needs to detect hypersonic missiles at extreme range. You cannot substitute aluminum in the electronic countermeasure system that needs to operate in high temperature environments. Silver is the material, and any nation that cannot secure silver cannot field the most advanced military systems. This is why governments are now involved in silver procurement in ways they have never been before. This is why defense contractors are holding emergency meetings with suppliers. This is why the word strategic is being used in classified briefings and policy memos. Silver is no longer just another commodity on the periodic table. Silver is a national security material. And when materials achieve national security status, markets cease to function normally. Governments intervene, export restrictions are imposed, stockpiles are built, and prices become disconnected from traditional supply-demand fundamentals because the calculus shifts from economic optimization to strategic security. The supply side of the silver market is in crisis. Not the kind of crisis that resolves in a few months when a new mine comes online or when recycling ramps up. The kind of crisis that takes years to resolve because the infrastructure to produce more silver does not exist and cannot be built quickly. Silver is not like oil, where you can drill more wells. Silver is not like wheat, where you can plant more acres. Silver comes primarily as a byproduct of mining other metals. 70% of silver production is a byproduct of lead, zinc, copper, and gold mining. Only 30% comes from primary silver mines. This byproduct nature creates a fundamental supply inflexibility. If you need more silver, you cannot just mine more silver. You have to mine more lead or zinc or copper, and those mining decisions are made based on the economics of the primary metal, not the byproduct. A copper mine operator does not increase production because silver prices are rising. They increase production because copper prices justify the capital expenditure and the operating costs. Silver is just a bonus, a credit that improves the economics but does not drive the decision. This means silver supply is structurally capped by the production rates of other metals. Global copper production grows at about 2 to 3% per year. Global zinc production is essentially flat. Global lead production is declining in some regions due to environmental regulations. If those are the constraints on primary metal production, then silver production is constrained by the same factors. The market cannot simply produce more silver in response to higher prices. Not quickly, not at scale. New mines take 7 to 10 years from discovery to first production. That is exploration, permitting, financing, construction, commissioning, a decade, and that assumes everything goes right. No permitting delays, no cost overruns, no technical challenges. In reality, most projects take longer, much longer. The major silver discoveries of the past decade are still years away from production. The projects that are in development are small, incremental. They add millions of ounces to a market that needs hundreds of millions more to balance. Recycling is often cited as a potential source of increased supply, and yes, silver is recycled from industrial applications, from jewelry, from photography chemicals, from electronic waste, but recycling rates are already high for the profitable streams. The silver that is easy to recover is already being recovered. The remaining sources are diffuse, contaminated, or economically marginal. Recovering silver from landfilled electronics requires expensive processing. Recovering silver from solar panels at end of life requires a recycling infrastructure that does not exist yet. The first generation of solar panels is only now reaching the end of their 25-year lifespan. The recycling capacity to handle the coming wave of retired panels is not built. It will not be built for years. So, supply is stuck. Production from mines is growing slowly. Recycling is growing slowly, and demand is growing rapidly. The gap widens every year, the deficit accumulates, and eventually the market runs out of inventory to draw down. That moment is approaching. The above-ground stockpiles that could buffer temporary supply shortfalls are depleting. The COMEX warehouses are at multi-year lows. The London vaults are seeing net outflows. The silver that was available to stabilize the market during past price spikes is not available this time. The buffer is gone. And without a buffer, the market is naked to any demand surge. What we are seeing now is the early stage of a scramble. The realization is spreading through corporate procurement departments and government resource ministries that silver is scarce and getting scarcer. The response to that realization is predictable. Secure supply now. Pay whatever it takes. Build strategic reserves. Do not get caught short. And when dozens of major consumers adopt that mindset simultaneously, the scramble becomes self-reinforcing. Each buyer who locks in supply removes that supply from the market. The removal of that supply makes the shortage more acute. The more acute shortage triggers more aggressive buying from the next wave of consumers. The cycle feeds on itself. This is not theoretical. This is documented. Solar manufacturers in China are building 6 to 12 months of silver inventory. Normally they carry 4 to 6 weeks. They are doubling and tripling their buffer stock because they watched what happened during the pandemic when supply chains broke and production stopped. They learned the lesson. Just-in-time inventory is fragile. Just-in-case inventory is survival. And right now, survival means hoarding silver. The electronics manufacturers in Japan and South Korea are doing the same thing. They are placing large forward orders. They are signing long-term supply contracts with guaranteed delivery. They are paying premiums that would have been unthinkable 2 years ago. 10% over spot, 15%, 20% in some cases for rush delivery. These are not companies that throw money around carelessly. These are disciplined manufacturers operating on thin margins. If they are paying these premiums, it means they have calculated that the cost of not having silver is higher than the cost of the premium. It means they believe the shortages will get worse, not better. The investment community is starting to catch on, not the retail investors. They have been buying silver for years, often based on monetary concerns or inflation hedging or distrust of fiat currency. The institutional investors are the ones who are just now paying attention. Hedge funds, family, offices, sovereign wealth funds. These are entities that manage billions. When they allocate even a small percentage to silver, the capital flow is enormous. A 1% allocation from a $10 billion fund is $100 million. If that fund tries to take physical delivery of $100 million of silver at current prices, they're trying to buy over 1 million ounces. That is a meaningful percentage of global refinery output, and there are hundreds of these funds globally. If even 10% of them decide to allocate to physical silver, the supply available to the market vanishes. We are already seeing signs of this institutional entry. Large bar transactions that do not show up in retail dealer inventory, vault space in London and Zurich being leased by entities that did not previously hold silver, refinery appointments booked months in advance. These are not visible in the normal market data. These are behind the scenes movements, but they are happening and they are accelerating because institutional investors do not move on sentiment. They move on data, and the data is screaming that silver is undervalued, undersupplied, and underowned relative to its strategic importance. Governments are the wild card. If governments decide that silver is strategic, if they decide to build national stockpiles the way they stockpile oil or rare earths or grain, the market will be overwhelmed. A single nation deciding to hold a 1-year supply buffer for its industrial needs would remove tens of millions of ounces from the market. The United States uses roughly 150 million ounces of silver per year for industrial applications. A 1-year strategic reserve would be 150 million ounces. That is nearly 20% of annual global mine production. One country, one decision, and the market would have to reprice immediately to reflect that new demand. There are rumors, unconfirmed but persistent, that certain nations are quietly accumulating silver, not through public announcements, not through official channels, through proxies, through state-owned enterprises, through sovereign wealth funds that do not disclose their holdings in detail. If those rumors are true, if governments are already positioning for a world where silver is scarce, then the public market is operating with incomplete information. The true supply-demand balance is tighter than the published data suggests, and when the truth emerges, when the scale of government accumulation becomes visible, the price will adjust violently. $100 per ounce is not just a round number. It is a psychological threshold. It is a price level that will trigger a cascade of reactions across the market. At $100, silver will have more than doubled from its multi-year average. At $100, silver will be above the inflation-adjusted high from 1980. At $100, silver will attract media attention, mainstream investor attention, and regulatory attention in ways that will fundamentally change the market dynamics. Media coverage amplifies moves. When silver was at $30, it was a footnote in the financial press. When silver hit $50 in 2011, it was front page news. It was on CNBC every hour. It was discussed on talk radio and in newspapers and in dinner conversations. And that media saturation brought a wave of retail buying that pushed the price even higher in a reflexive feedback loop. The coverage drove interest. The interest drove buying. The buying drove the price. The price drove more coverage. At $100, that cycle will restart. And this time, the underlying shortage is real. It is not driven by speculation alone. It is driven by structural supply-demand imbalance. So the buying that comes from media attention will hit a market that has no inventory buffer. The price will not top out at 110 or 120 the way it did in 2011. It will keep going. Mainstream investors will enter the market at $100. These are the people who do not follow commodities, who do not understand supply chains, who are just now hearing about silver for the first time because it is in the news. These are the latecomers, the momentum chasers, the people who buy because the price is going up and they do not want to miss out. In a normal market, these are the buyers who arrive at the top. They are the exit liquidity for the early investors. But in a supply-constrained market, these buyers do not mark the top, they mark the acceleration phase because their buying removes more physical metal from an already depleted market, and their presence signals to other mainstream investors that silver is a legitimate asset class, which brings even more capital. Regulatory attention at $100 could go either way. Regulators could see the price move as evidence of a functioning market responding to supply constraints, or they could see it as evidence of speculation and manipulation that requires intervention. If regulators intervene, if they impose position limits or margin requirements or trading halts, the intervention could temporarily suppress the price. But intervention does not create silver. Intervention does not resolve the shortage. Intervention just delays the inevitable repricing. And when the intervention is lifted, when the market is allowed to trade freely again, the price resumes its climb. Possibly more violently than before because the suppressed demand was building pressure during the intervention period. The path to $100 is clear. Silver is currently in the mid-80s. It needs to rise 15 to 20% to reach 100. That is not a massive move in commodity terms. Silver has moved 15% in a week multiple times in the past few years. The question is not whether silver can reach 100. The question is what happens after 100, and the answer depends on how quickly supply responds and how persistent demand remains. If supply cannot respond, if the refinery bottlenecks and the mining constraints and the recycling limitations prevent a meaningful increase in available silver, then demand will persist. Industrial buyers will keep buying because they need the metal. Investment buyers will keep buying because the shortage validates their thesis. And the price will rise until it hits a level where demand finally breaks, where solar manufacturers shut down because they cannot afford silver, where electronics producers switch to inferior alternatives because silver is too expensive, where investors decide the price has gone too far and sell. That price could be 120, it could be 150, it could be 200. No one knows because we have never tested the upper bound of industrial silver demand. We have never pushed the price high enough to find out what it costs to actually destroy demand in mission-critical applications. Let me walk you through what the next few weeks could look like. This is not prediction. This is scenario analysis based on current conditions and observable trends. Week 1, silver is trading between $85 and $90. The volatility is high. Intraday swings of 5 to 10%. The trading is chaotic. Algorithms are fighting each other. Long-term holders are sitting tight. Short sellers are getting destroyed. The media is starting to notice. The headlines are cautious. Silver surges on supply concerns. Industrial demand drives silver higher. The coverage is factual, but not alarmist. Yet. Week 2, silver breaks $90. The breakout is clean. No resistance, no meaningful pullback. The buying is relentless. Every dip is absorbed within hours. The premiums on physical silver are widening. Coins and bars are trading at $12 to $15 over spot. Dealers are extending delivery times to 8 weeks. 10 weeks for larger orders. The online precious metals retailers are showing red across their inventory pages. Out of stock, pre-order only. Expected availability unknown. The retail investors who sat out the move from 60 to 85 are panicking. They are buying whatever they can find. They are paying premiums they swore they would never pay because they watched silver double and they do not want to watch it double again from the sidelines. Industrial buyers are escalating their procurement efforts. The procurement managers who thought the shortage was temporary are realizing it is not. They are calling their suppliers daily. They are asking for status updates. They are offering to pay deposits. They are signing contracts with price escalation clauses that would have been rejected months ago. The suppliers are telling them the same thing. The refineries are backed up. The lead times are extending. We cannot commit to delivery dates beyond the next quarter. The industrial buyers are going higher up the chain. They are contacting refineries directly. They are contacting mining companies. They are trying to bypass the usual distribution channels to secure metal. And they are learning that even the refineries and the mining companies are overwhelmed with demand. Week 3. Silver is at $95. The psychological barrier of 100 is visible. The market can feel it. The energy is electric. The options market is going insane. Call options that were out of the money 2 weeks ago are now deep in the money. The traders who bought those calls are making 10 times, 20 times their investment. The options dealers who sold those calls are scrambling to hedge. Their delta hedging is buying futures. The futures buying is pushing the price higher. The higher price is increasing the delta on the remaining calls. The dealers have to buy more futures. This is a gamma squeeze on top of a physical shortage, on top of an industrial panic. The reflexivity is extreme. The mainstream media coverage intensifies. Silver is now a lead story. CNBC is running silver price tickers. Bloomberg is publishing deep dive articles on the supply situation. The Wall Street Journal is interviewing mining executives and refinery operators. The narrative is shifting. 2 weeks ago, the coverage was about supply concerns. Now the coverage is about a potential crisis. The word crisis matters. Crisis brings attention. Crisis brings capital. Crisis brings government involvement. And all three things push the price higher. The short sellers who survived the move from 60 to 95 are capitulating. They have been bleeding for weeks. Their margin calls are constant. Their prime brokers are threatening to close their positions. Some of them try to hold on. They believe $100 is the top. They believe the market will reverse. They are wrong. Their forced buying at 95, 96, 97 adds fuel to the final push. By the end of week 3, silver is at $99. The market is holding its breath. Week 4, silver crosses $100. It happens in the Asian session. Shanghai opens and the buying is immediate. The price gaps from 99 to 103 in the first 15 minutes. No trades at 100, no trades at 101. The order book was empty. The market jumped. When London opens, the price is confirmed, $103. When New York opens, the price is $107. The momentum is unstoppable. The media is calling it a silver mania. The financial Twitter is exploding. The Reddit forums are overwhelmed with posts. The Google searches for how to buy silver are spiking. The mainstream has arrived, but this is not 2011. In 2011, the buying was speculative. It was driven by fear of currency collapse and distrust of central banks and the aftermath of the financial crisis. The industrial demand was present, but it was not the driver. This time, the industrial demand is the driver. The speculators are along for the ride, but they are not the cause. The cause is a structural shortage. The cause is decades of underinvestment in mining. The cause is a technology transition that requires more silver than the market can provide. And that cause does not go away when silver hits 110 or 120. That cause persists. And as long as it persists, the price pressure continues. By the end of week 4, silver is trading between 110 and 120. The range is wide because the volatility is extreme, but the direction is clear, up. And the question is no longer whether silver will stay above 100. The question is how high it can go before something breaks. Something always breaks in a market dislocation. The system is not designed to handle sustained vertical price moves. The infrastructure creaks, the participants panic, the mechanisms that are supposed to provide stability and liquidity fail. So what breaks first in a silver market that is above $100 and climbing? The futures market is the most likely failure point. The COMEX silver futures contract is the primary price discovery mechanism for silver globally. It is where industrial hedgers and speculators and investors interact. It is where the paper price is set. But the futures market operates on leverage. Participants post margin, which is a small fraction of the contract value, and they gain exposure to large quantities of silver without owning the actual metal. This works fine when prices are stable. This works fine when margin requirements are adequate relative to volatility. But when prices go vertical, when daily moves are 10 or 15%, the margin requirements become insufficient. Participants blow through their margin. They default. The clearinghouse has to step in. And if enough participants default simultaneously, the clearinghouse itself is at risk. The London Bullion Market Association, which governs the over-the-counter physical market, could also face stress. The LBMA operates on an allocated and unallocated basis. Allocated means you own specific bars in a specific vault. Unallocated means you own a claim on silver but not specific bars. Most industrial buyers and investors hold unallocated silver because it is cheaper and more flexible, but unallocated silver is fractional reserve. The banks that provide unallocated accounts do not hold 100% backing. They hold a fraction, and they rely on the fact that only a small percentage of clients will demand physical delivery at any one time. If a large percentage demands delivery simultaneously, the banks cannot deliver. They do not have the metal. They have to buy it in the market at the current elevated price, and that buying pushes the price even higher. This is a bank run scenario, not a traditional bank run where depositors demand cash, a bullion bank run where account holders demand metal, and bank runs do not resolve gracefully. They resolve with emergency measures, with delivery delays, with cash settlement instead of physical delivery, with contract modifications, with government intervention. All of these measures undermine confidence in the paper market. And when confidence in the paper market is undermined, participants shift to the physical market. They demand delivery, they buy coins and bars, they remove silver from the banking system, and that shift accelerates the shortage. Industrial users could start failing, not the large corporations. They have balance sheets and credit lines. They can survive elevated silver prices for quarters or even years. But the smaller manufacturers, the component suppliers, the businesses that operate on the thin margins and tight cash flow, they are vulnerable. If silver is $120 and they locked in contracts at $60, they are losing money on every unit they produce. They cannot pass the full cost increase to their customers because their customers will switch to competitors or alternative products, so they absorb the loss. They bleed cash, they hope the price comes down. And when the price does not come down, when months pass and silver is still above 100, they shut down, they lay off workers, they default on obligations, the supply chain fragments. The political response is unpredictable but inevitable. Governments do not like commodity price spikes. Price spikes cause inflation. Inflation causes political instability. Politicians face pressure to do something. The something could be strategic reserve releases. The United States has a strategic petroleum reserve. It does not have a strategic silver reserve, but it could create one, or it could order industries to release silver from their inventories. It could impose export restrictions to keep domestically produced silver in the country. It could impose price controls or windfall taxes on silver mining companies. All of these interventions distort the market. All of them have unintended consequences. But politicians are not concerned with market efficiency. They're concerned with perception, with being seen to act, and their actions, no matter how misguided, will affect prices. The most extreme break would be a trading halt. If the COMEX decides that the price move is disorderly, if regulators pressure the exchange to intervene, trading could be suspended. This happened with nickel in 2022. The London Metal Exchange halted trading and canceled trades after a short squeeze, sent prices vertical. The decision was controversial. Traders who were profitable had their profits erased. Traders who were losing were given a reprieve. The integrity of the market was questioned. But the exchange made the decision because the alternative was a clearinghouse failure. Silver is larger than nickel. Silver has more political sensitivity. But the same logic could apply. If the clearinghouse is at risk, if defaults are cascading, if the system is on the verge of collapse, the exchange could halt trading. And that halt would confirm that the paper market has failed, that physical silver is what matters, and that the price when trading resumes will be even higher. Here's what makes this moment unique. Here's why the next few weeks represent an asymmetric opportunity that will not repeat. The market is transitioning from paper pricing to physical pricing. That transition happens rarely. Once in a generation, maybe once in multiple generations. The last time precious metals transitioned from paper to physical pricing was in the 1970s when the gold standard collapsed and physical gold became the refuge from monetary chaos. Silver followed gold higher, reaching $50 in 1980. That was 45 years ago. An entire generation of investors has never experienced a precious metals mania driven by physical shortage rather than financial speculation. The asymmetry is in the risk reward. The downside is limited. Silver is not going to zero. Silver is not going back to $20. The industrial demand floor is too high. The supply is too constrained. The strategic importance is too great. Even in a severe recession, even in a market crash, silver has tangible value. It has use cases. It has buyers who need it for production. The worst case scenario is that silver pulls back to 70 or 75 if there is a broad commodity sell-off or a panic liquidation. That is a 15 to 20% downside from current levels, painful but survivable. The upside is exponential. If silver reaches 120, that is a 40% gain from 85. If silver reaches 150, that is a 75% gain. If silver goes to 200, which is not impossible in a full-blown shortage scenario, that is a 135% gain. The upside cases are multiples of the downside case. That is what asymmetry means. The potential gains are much larger than the potential losses. And in investing, when you find genuine asymmetry, when the math is in your favor, you position accordingly. But asymmetric opportunities require conviction. They require the ability to hold through volatility. They require ignoring the noise and the skepticism and the voices telling you to take profits, because the crowd does not understand asymmetry. The crowd thinks in terms of symmetry. They think a 30% gain should be taken because a 30% loss would be painful. They do not think in terms of probability-weighted outcomes. They do not think in terms of structural shifts. They think in terms of fear and greed, and fear always dominates. So they sell early, they miss the exponential phase, they watch from the sidelines as the price doubles or triples from where they exited. The investors who capture asymmetric moves are the ones who do the work, who understand the fundamentals, who can articulate why this time is different and this time is different. Silver is not in a speculative bubble. Silver is in a supply crisis. Bubbles are driven by leverage and euphoria and the expectation of future gains disconnected from reality. Crises are driven by scarcity and necessity and the realization that the market cannot provide what is needed. Bubbles pop. Crises do not pop. Crises persist until supply increases or demand decreases. And neither of those things is happening quickly in silver. This is why the scramble for strategic silver is the most important development in the commodity markets right now. This is why $100 is not the end, but the beginning. This is why the next few weeks will determine who captures generational wealth and who watches it happen. The window is open, the opportunity is visible, but the window will not stay open forever. At some point, the price will be so high that the risk-reward will no longer be asymmetric. At some point, the shortage will resolve or the demand will break. At some point, the move will be over. But that point is not now. That point is not at $85. That point is not even at $100. That point is higher, much higher. And the investors who recognize that, who act on that recognition, will be positioned to profit from one of the most significant commodity dislocations of the modern era. So, where do we go from here? Silver is in the mid-80s. The trend is up. The fundamentals support higher prices. The technical picture is bullish with no meaningful resistance. The supply situation is deteriorating. The demand is inelastic. The scramble is intensifying. Every indicator points to $100 within weeks. And once 100 is breached, once that psychological threshold is crossed, the market enters uncharted territory. The path forward is not linear. There will be pullbacks. There will be days where silver falls 5 or 7% and the bears declare victory and the media writes about the bubble popping. Ignore it. Those pullbacks are noise. They are profit-taking by short-term traders. They are margin call forced selling. They are algorithmic stop-loss triggers. They are not changes in the fundamental supply-demand balance. As long as refineries are backlogged, as long as dealers are sold out, as long as industrial buyers are paying premiums, as long as the physical market is tight, the dips are buying opportunities, not selling opportunities. The path forward requires information discipline. You will be bombarded with opinions. Analysts will say silver is overbought. Technicians will point to resistance levels that are meaningless in a supply crisis. Skeptics will say this is just like 2011 and silver will crash back down. Do not let their skepticism become your doubt. Do your own research. Look at the warehouse data. Look at the refinery lead times. Look at the dealer premiums. Look at the industrial consumption trends. The data is public. The data is clear, and the data supports the thesis that silver is headed higher. The path forward demands position sizing discipline. Do not over-leverage. Do not bet money you need for living expenses. Do not use margin in a volatile market. Physical silver is the safest exposure. Coins, bars, allocated storage. No counterparty risk. No default risk. You own the metal. It exists. It is yours. If you want leverage, use equity in silver mining companies or silver royalty companies. But understand that equity is more volatile than the metal. Equity can go to zero if the company makes bad decisions. The metal cannot go to zero. The metal is tangible. The metal has value. So the core of your position should be physical. The periphery can be equity or other derivatives if you want to amplify returns. But the core should be the metal. The path forward requires psychological preparation. Holding through a 100% gain is harder than it sounds. Your brain will tell you to sell. Your brain will remind you of all the times you held too long and gave back profits. Your brain will create fear where there should be conviction. This is normal. This is human. But this is also the reason most people do not capture asymmetric moves. They cannot override the fear. They cannot trust the analysis. They cannot hold through the discomfort. If you're going to capture this move, if you're going to ride silver from 85 to 100 and beyond, you need to prepare yourself psychologically. You need to write down your thesis. You need to define the conditions under which you will sell. And those conditions should be based on fundamentals, not on price. Sell when the shortage ends. Sell when supply catches up. Sell when premiums collapse. Sell when industrial users stop panicking. Do not sell because the price hit a round number. Do not sell because you doubled your money. Do not sell because you are scared. Sell when the data tells you the move is over. The path forward is clear. Silver is going to $100. It is going there within weeks. And it is likely going beyond 100 to levels that will shock the market and the media and the latecomers who did not believe the shortage was real. This is not speculation. This is not hope. This is analysis based on observable conditions and rational extrapolation of current trends. The scramble for strategic silver is real. The supply is constrained. The demand is inelastic, the stage is set, and the investors who position themselves now, who understand the magnitude of what is unfolding, will look back at this moment as a defining opportunity in their investing lives. The countdown has begun. The weeks ahead will be volatile, dramatic, and historic. Position yourself accordingly. Trust the fundamentals. Ignore the noise and hold through the chaos. Because on the other side of $100 is a repricing of silver that reflects its true strategic value in a world that needs it more than ever and has less of it than anyone realizes. This is your window. This is your moment. Do not waste it.